Okay, so keep in mind that the cyclical nature of what I'm describing to you here affects economic growth and contraction. This is an example of cycles on economic growth in the U.S., and this is U.S. GDP, quarterly GDP, but I've thrown a lot of annotations on here. Some of you might remember this chart. I'm just throwing it up here because it's a very important point. U.S. GDP, whenever we drop below that zero line, that red dashed line, for 2 consecutive quarters, negative quarters, that is a sign of a recession. And keep in mind that if we do have a setback of more than 10% on the equity market, or a spike in oil, given the geopolitical risks that are approaching in July, and many other tail risks, maybe Europe contagion getting worse, whatever. If any one of these black swan events hit the market again, it could be a recessionary event. And just keep in mind that recessions are natural. They happen on a regular basis, as we all know. And the key point I'll make here is that the 2008 and 9 recession that we had was the fastest contraction that we saw since the Great Depression. In the second quarter of 2008, GDP dropped by minus 8.9%. In the second quarter of 2008, GDP dropped into negative territory by 8.9% and surprised the hell out of a lot of market experts around the world. The recession lasted for 18 months, and it was quite a deep, protracted recession, and maybe for that reason, a sustainable recovery was inevitably unsustainable. And certainly we've seen the weakest expansion since World War II. Even though we do have positive GDP, it hasn't been that sustainable overall. And just look at the 1980-82 example, where you see here a potential historical parallel for a double-dip recession. So I won't say any more about that, but just keep in mind these market moves will affect the economy. Currently, the economy is doing its very best to recover from a very low base, from a very deep recession in 2008 and 9, which triggered the fastest contraction, minus 8.9% in the second quarter of 2008. So these moves can happen pretty fast and move against popular opinion. Out of about 70 economists around the world working for the biggest banks, the consensus opinion is that US GDP stays around 3% or 1% as a worst-case scenario. Not many people in the market, if anyone in the big institutions, is pricing in any type of negative growth or recession this year. And I think it is important to look at both sides of the trade, not just to have a one-way trade without an exit strategy. So that's all I have to say about that. And so the big question mark is, do we see anything like that in 2012, a potential double dip recession, or just negative growth? Time will tell. Okay. Any questions on what I just mentioned? Just maybe save it until the end. What is your take on the 7-year cycle? Let me come back to that. But just one point I will say is the chart I showed you on US GDP actually has a 10-year cycle inbuilt, a 10-year and a 4-year cycle. And I tend to use these long-term, medium-term cycles as a proxy, business cycle. Okay, macro cycles. I'm just going to quickly talk about what the second quarter of this year might mean for volatility and what it means for the real markets out there, Western equity markets. So let me launch into that quickly. So the big thing I want each of you to keep in mind is whatever market matters to you the most, what you want to know, and I'm guessing what you are most interested in, as I am, is what is going to happen to volatility. Volatility has been historically low. As you can see here, this is a chart of the VIX, which in my opinion is signaling a rise in volatility. But the VIX, when I printed this chart a while ago, was pushing to extremely low levels from, into, under the 17 mark, into the teens, the comfort zone levels, from a very high drop. So remember, the VIX index, the sign of volatility on the S&P, was trading around 45 and even higher than that. And over the course of several months, it dropped dramatically. Now, obviously, we've seen an increase since, but my point here, very simple point, that volatility is likely to increase very quickly, very soon. So it would be better for you to be on the cautious side and maybe try and lock in some profits or just be a little bit conservative on any money that you would have made in the market, specifically the equity markets, which have moved to highs the quickest. Now that's one point. Volatility signals a rise. But the second point is seasonality. Now part of my cycle work focuses on seasonality. Every market, and volatility for that matter, has a seasonal performance that we can measure. And what this shows is that the spring months of each year tend to be the times of the year when volatility increases. So you can see here March to April 2011, big spike in volatility. 2010, April to May, we had a big spike in volatility. So beware of the spring months. So I would say as we approach the end of March, certainly April and May, keep in mind that we're likely to get a big increase in volatility based on the VIX and any other proxy that you look at. And the famous market phrase is sell in May and go away. We may need to sell earlier than that, but keep in mind this is a well-known financial market proverb, mantra belief, that equity markets tend to sell off into the summer period. And so before the summer, during the spring period, second quarter, we are likely to traditionally see an increase in volatility and a healthy setback in the equity market. Now, someone just asked the question, why volatility is so low while the Dow is so high? And this is a very important point. Isn't that interesting? And that is interesting in that that's partly why the equity markets are doing so well. Because volatility is so low, people's comfort zones are very stable. We all feel comfortable because volatility is low. So we think that we can trade day in, day out, make money tomorrow and the next day, and go to sleep at night very peacefully because volatility is low. So when volatility is low, it increases our optimism and it increases our conviction in the market. We feel smarter and we feel like we can make more money, and so we trade more. And so for that reason, this buy and hold type of mentality it has developed on the equity market specifically, and more so within the US stock market. Does that help? So low volatility increases optimism and greed in the market, specifically the equity market, and that is why we have seen markets like the US S&P and the Dow Jones Index reach new highs, even though volatility is quite low. Low volatility increases our confidence in the market and increases our capital investment in the market. That's the long and short of it. But of course, keep in mind that when volatility increases, we become more uncomfortable and we withdraw our money from the market. We scale back our trades. Maybe margin calls are being triggered, and we get scared, and it creates contagion. So even markets which look great fundamentally, increasing volatility just makes us scared, and we scale back. So keep in mind both sides of this equation of volatility.